HSBC, the latest of the banks, coming out with a higher price target. Do you agree with either of the cases, but specifically the most bullish one, where AI is going to have a big impact on earnings?
I think there's two aspects here. So I think we are bullish on the US, and I am bullish on market returns for the rest of this year. And I think that the narrowness of the market is what can contribute to that, because it's not so much about what the market's going to do. It's more about where those returns are going to come from. I think that there may be a bit of a stall in the mega caps that have driven the US returns thus far over the past year in particular. But I think we've got scope for some broadening in returns from the rest of the market. You've seen a huge bifurcation in returns. It's big laggards down there of companies that are able to grow their earnings and do very well. And I think that you may just find a broader participation, which should sort of lead the market higher through the year. I think that we have to be careful with AI, because it's already been integrated in companies for many years in many cases, and I just think we have to think about the sort of pull forward of demand and that's being priced into some of these larger companies that are dominating that rally at the minute. And so if they fail to meet their expectations, and they've been building out capacity for this big AI need, then we could see some setbacks in some of those larger names.
Okay, we're going to be talking a lot more about the impact of AI on a number of companies a bit later in the show. One thing I do want to note, though, is there is actually quite a bit of bullishness on Wall Street. 8 of the 14 banks that we track have raised their S&P price targets, but the median, it's only 51.25. Also want to talk to you about the Fed. HSBC forecasting 3 rate cuts yesterday. We saw the Atlanta Fed president, Raphael Bostic, forecast only 1 rate cut. Where are you at when it comes to Fed rate cuts on the U.S. side? And how important is that for the outlook for the S&P going forward?
I mean, I think the Federal Reserve have been, very clear about their sort of 2% inflation target. I don't know so much about how many rate cuts there will be this year. And I almost, it's not so much for me about how many there will be. I like to look at things on a bottom-up basis, and it's the impact on the equity market that I'm really interested in, and that higher rate environment and inflation, and also the bond yields being higher as well. I mean, that's already being felt, in a large part of the equity market. It really is being masked by just a handful of names in that Magnificent Seven, group in particular, that are driving index returns higher. So I think we are actually already starting to see the impact of that higher rate environment in a lot of the equity market that's simply lagging behind. The narrowness is really showing that. So, perhaps those largest companies aren't discounting that rate cut, but much of the market is.
So you're mentioning the rising bond yields, higher cost of capital, and another thing you're looking at is the forward PE of the market. So back in October, the S&P was trading at about 18 times forward PE. Now it's at 21 times forward PE. For you, is that just running too hot? Is that too, quote unquote, frothy?
I think that we just haven't seen earnings expectations catch up with it. So I think you've just seen a re-rating. There's been sort of driving the market higher. And I think that for us to move higher from here, it's really important that earnings move up instead of things just getting more expensive. So, I think it's really important to focus on stock selection where you've got companies that are able to durably grow their earnings as opposed to just trend sideways or even slower growth. And you can see it in companies like Apple is a really good example. It's, very large business, and it's not managing to grow its earnings so much. Okay. And, it's lagging this year. And I think that the market will be quite punitive on companies that can't deliver on growth.